In Don't Buy Target Date or Lifecycle funds, we'll be reviewing the embedded opportunity cost in these types of investments, which are often the default in 401k plans. And we'll be using the government's Thrift Savings Plan or TSP to review these types of investments, but they all operate basically the same. An employee picks the retirement year and a fund manager picks the strategy, which isn't always optimized for risk and return and are often too diversified and too conservative, which is what I found during my research on TSP lifecycle funds. And while this video isn't meant to be specific advice for you, if you find it helpful, make sure you hit like and share, because there are millions of Americans that don't know what they don't know, and it's hurting their retirement. So without further ado, this is Don't Buy Target Date or Lifecycle Funds. So this is the Thrift Savings Plan or TSP's website. You can get information on the funds and performance by clicking these links. The two conservative investments available inside TSP are the G Fund, which invest in government securities or bonds, and the F Fund, which invest in a more diversified basket of fixed income or bonds. These are generally considered low-risk investments and average 4 to 5% returns over their existence. The growth investments available in TSP are the C, S, and I funds. The C Fund is large U.S. stocks, the S Fund is small U.S. stocks, and the I Fund is international stocks. They're generally considered to have more risk or variance, which makes sense because they generally have more return. Over their lifetimes, the C Fund averaged 11.18%, the S Fund 9.2%, and the I Fund 5.4%. And I can immediately see that an optimized portfolio for growth is going to have more allocations to the C Fund than any of the other funds, because what the C Fund averages per year, it takes the G Fund more than 2 years to achieve. And here's a visual to explain the importance of compounding over time. Let's have you do a one-time deposit of $10,000 into the G Fund, and let that deposit compound and reinvest at 4.65% per year. At the end of 40 years, you would have a theoretical balance of $61,598, which seems pretty good at more than 6 times your initial $10,000 deposit. But now let's do that same $10,000 initial deposit into the C Fund. And because of the power of compounding at more than twice the expected return, your ending theoretical balance would be closer to 70 times your initial deposit, for an additional growth of $631,934. And if that difference seems hard to believe, here are my calculations so you can check them, which don't account for variance and inflation, but do demonstrate the power of compounding. But presumably, this is the type of analytical work that is going into the decisions that are being made by the Federal Retirement Thrift Investment Board, or FRTIB, who oversees the Thrift Savings Plan, and here is their website. The FRTIB is charged by law to administer the TSP solely in the interest of the participants and beneficiaries. We seek to improve participant retirement outcomes, provide top-tier defined contribution service to participants, function as a high-performing agency, and transition successfully to a managed services operating model. So it's this agency who is in charge of making decisions for TSP's lifecycle funds. And from TSP's website, we find this information. Each of the 11 L funds is a diversified mix of the 5 individual funds, G, F, C, S, and I. They were designed to let you invest your entire portfolio in a single L fund and get the best expected return for the amount of expected risk that is appropriate for you. Every quarter, or 3 months, the target allocations of all the L funds, except L income, are automatically adjusted, gradually shifting from higher risk and reward to lower risk and reward as they get closer to their target dates. When an L fund reaches its target date, it goes out of existence, and any money in it becomes part of the L income fund, which generally keeps the same target allocation. For example, in 2025, the L 2025 fund will be rolled into the L income fund. One of the important things about the L funds is that they stick to their target allocations for a full quarter regardless of what the markets do. Every trading day, some of the individual funds in an L fund will do better than others. At the end of the day, the individual funds that did better will make up a higher percentage of the L fund than the ones that did less well. To maintain each L fund's target allocation, we rebalance it at the end of every trading day. We do this by buying and selling the individual funds that make up the L fund so that the percentages go back to what they were at the beginning of the day. In effect, we're buying low and selling high at the end of every trading day. And that's an obvious error to me being committed by the TSP Lifecycle Fund Manager. While it sounds good in theory, it's not in practice. Increasing the frequency of rebalancing to daily will more often result in them selling stocks too soon than the fund will benefit from profit taking or risk reduction, so they should really take a longer term approach to investing and reconsider the practice of daily rebalancing. But we can use these links to get more specific information on any of the Lifecycle funds. Here's the L2065 Lifecycle Funds page. There's its average annual returns, there's its allocation target, and we can even see its allocation targets all the way out until 2065, when it will go out of existence and be consolidated into the L Income Fund. You can also find this information in the August 2024 Thrift Savings Plan Fund Information Guide. The information in this book will help you decide how to invest your account. Consider both risk and return. You need to be comfortable with the amount of risk you expect to take. You can reduce your overall risk by diversifying your account. This one's interesting. Generally, it's best not to put all your eggs in one basket. There is only one non-diversified fund in TSP, and it's the G Fund, as 100% of the securities in it are from one issuer, the United States government. The F Fund is diversified in that it invests in thousands of fixed income and bonds from different issuers, including the U.S. government. The C Fund is diversified because it invests in 500 large U.S. companies, like Apple, Amazon, and even Warren Buffett's Berkshire Hathaway, and is exposed to all major industry groups. The S Fund is diversified because it invests in all the mid and small U.S. companies not in the C Fund, and also has exposure to all the other major industry groups. And the I Fund is diversified because it invests in companies in many developed countries outside the United States, like France, the United Kingdom, and Japan, to name a few. And more information on Lifecycle funds. And let's read this. The graph below illustrates what investment experts call the efficient frontier. The yellow line plots the portfolios that offer the highest expected return for a given level of risk, or the lowest risk for a given level of expected return. All the L funds were designed to be as close as possible to the efficient frontier. As the target allocations of each L fund are adjusted every quarter, the funds gradually roll down into the left on the graph until they merge with the L Income Fund. When necessary, a new L fund is introduced with a target date that is farther away, which means its expected risk and return will be on the upper right section of the efficient frontier graph. So I'm an investment expert, and I can tell you that efficient frontier graphs should never be linear like this, because it implies that every incremental unit of risk yields the same amount of return, which is never the case. And second, I think TSP should have defined what type of risk is being graphed on the x-axis. In this case, it's obvious to me they are graphing expected market risk or variance, because as we move up and out on the graph, the allocation to stocks increases. But what if instead we were graphing expected inflation risk, where we were graphing all the Lifecycle funds' risk of losing real value because of inflation? Then the graph would look like this, where the later year Lifecycle funds with the highest expected returns have the lowest risk of losing real value because of inflation, and the L Income Fund with the highest allocation to the G Fund would have the highest risk of losing real value. If we graphed your risk of not having enough assets in retirement, then the Lifecycle fund with the lowest expected return would also have the highest risk of creating an asset shortfall, which would also be the L Income Fund. So I think they should have defined what type of risk was being graphed a little more clearly. And now that we have a basic understanding of the Thrift Savings Plan and Lifecycle funds, let's do a quick recap. There are 5 individual funds in TSP, C, S, and I for growth, and G and F for preservation, and a bunch of Lifecycle funds. The Lifecycle funds are managed by the Federal Retirement Thrift Investment Board and are structured to become more conservative as the target year approaches. TSP currently offers funds from 2030 to 2070. When these funds hit their retirement year, they go out of existence and become the L Income Fund. If you have more than 28 years left on your Lifecycle fund, this is how your Lifecycle fund is invested. 51% C, 13% S, 35% I, and the remainder in the G and F. Starting 28 years out from a Lifecycle fund's target retirement year, some of your growth stocks are sold and the proceeds shifted to the G and F funds each quarter. This process occurs at this rate for 23 years and at a faster rate for the last 5 years, until your Lifecycle fund's year is reached when you are consolidated with all the other investors in the L Income Fund, with a target allocation of 62% G, 5% F, 17% C, 4% S, and 12% I. So the 2 questions we need to ask are, how well are these allocations optimized for risk and return, which goes back to what investment experts call the efficient frontier, and what are the expected opportunity costs associated with starting to shift an investment portfolio for retirement 28 years before retirement? To answer these questions, we're going to use portfoliovisualizer.com, which is one of my favorite free resources available on the internet for investors. And we'll click Efficient Frontier under the Portfolio Optimization tools. And there's an example of a more standard Efficient Frontier graph. And it's time to do some analysis. First, let's set asset constraints to no, because we just want to know what the best risk to return portfolio is for growth right now. Second, let's set the assets to the 28-year plus allocation mix that the TSP Lifecycle funds are using. Approximately 52% C fund, 13% S fund, and 35% I fund. And now let's review results. So the provided portfolio was TSP's strategy, and the optimized risk to return portfolio is 100% C fund. The TSP strategy had an expected return of 10.6% per year with a 15.22% standard deviation, which is a common way to define risk. And the C fund had an expected return of 11.81% over the same time frame with a 15.31% standard deviation. And in general, it's not wise to give up 1.21% of annual expected return for a 0.09% risk reduction, so that doesn't look optimized at all, which can be confirmed with the Efficient Frontier graph. This is the TSP's 51-13-35 investment mix with the 10.6% expected return and 15.22% standard deviation. And with the same amount of 15.22% standard deviation, the 100% C fund strategy achieves a higher expected return of 11.7%. So it appears that it would be more efficient to invest in the C fund than any of the TSP lifecycle funds if your objective is growth. So that answers question number 1. I would not recommend investing in TSP's lifecycle funds if you are more than 28 years out from retirement because their 51% C, 13% S, and 35% I allocation appears to be suboptimal, and instead would recommend 100% in the C fund, and I'm fine with the level of diversification the 500 companies inside the C fund offer. Now it's time to move on to question number 2. What are the expected opportunity costs with starting to prepare an investment portfolio 28 years out from retirement? To answer this question, we can use Portfolio Visualizer's Financial Goals Monte Carlo simulation to run a hypothetical scenario 10,000 times. First, we will need to set our parameters. We are going to assume a 40-year working career where the employee contributes to their 401k every month using a TSP-type investing strategy that will start to shift to be more conservative 28 years prior to retirement. And we're going to assume the employee contributes $250 a month to their 401k starting with their first paycheck and rebalances as often as this software will allow since TSP rebalances daily. We'll set the start portfolio to TSP's growth lifecycle allocation that the participant either chose or was automatically selected for him or her by default, and we'll set their ending portfolio to the TSPL income fund allocation mix, which currently is invested like that. And for the employee's financial goal, we'll do 401k savings at a rate of $250 per month, increased by the rate of inflation each year until retirement. So this is TSP's starting lifecycle fund, this is TSP's retirement L income fund, there's the 40 years of $250 deposits, and there's our Monte Carlo simulation results. In the middle, or 50th percentile of those 10,000 iterations, the employee averaged an 8.06% return and ended up with a portfolio worth $361,000 in today's dollars. Now let's see what happens with the exact same parameters as before, but with one single change. Instead of starting to shift from a growth to a conservative portfolio, starting 28 years out from retirement, we'll do it with 5 years left before retirement instead. Same 40-year career, same suboptimal TSP investment strategy in the early years, same L income strategy at retirement, same $250 monthly contributions, but delaying the transition from 28 years out to 5 years caused the expected real value of the 50th percentile to increase from $361,000 to $499,000, or approximately $138,000 more. Or to put it another way, the opportunity cost of shifting from growth investments to the G fund 28 years before retirement instead of only 5 years before retirement is theoretically costing TSP employees 38% of their potential retirement assets. But we ran these two scenarios with the investment mixes that we know to be suboptimal. What happens when we use the same parameters, but instead invest 100% in the C fund during growth years, with the shorter 5-year glide path when transitioning to retirement? consisting of the same allocation to growth and conservative funds at retirement and $250 monthly contributions. Now the expected real value of the 50th percentile of our simulation is $743,000, or approximately $382,000 more than the base TSP strategy that ended with an expected real value of $361,000. Or, to put it another way, the opportunity cost of the combined suboptimal investment mix and the decision to shift investments to the G fund 28 years before retirement instead of 5 years out theoretically cost an investor $382,000 of their potential retirement portfolio, or more than half. One last scenario, with the same exact parameters as before, but instead of going to 68% bonds in retirement, we only go to 10% bonds to stay growth-oriented. The expected real value of the 50th percentile of the simulation is now $787,000, or approximately $426,000 more than the base TSP strategy, that ended with an expected real value of $361,000, or less than half the potential theoretical retirement assets. And when you cut your theoretical retirement assets by over half, you also cut your theoretical retirement income by over half, and let me explain. These are two of the glide paths we just reviewed, with the 40-year career scenario depositing $250 monthly into a 401k. This one is the base TSP strategy that starts shifting to a more conservative mix 28 years before retirement. And this one is the optimized 100% C fund strategy that shifts to the 90-10 allocation 5 years out from retirement. The TSP plan had an ending theoretical portfolio value of $361,000. The C fund plan had an ending theoretical portfolio value of $787,000. And if we use the lifetime average return of the L income fund of 4.43% as how much an individual could withdraw from their account every year, which is not really how that works, but will work for this illustration, then 4.43% times $361,000 implies an annual income of about $16,000 or $1,335 per month. And if we use the lifetime average returns of 5.38% for the F fund and 11.18% for the C fund, then this portfolio has an expected return of 10.6% per year. And 10.6% times $787,000 is $83,000 of annual income, or $6,956 per month, which means TSP's suboptimal strategy is costing participants about 81% of their potential optimized income in this scenario. And those are massively different retirement lifestyles. Now, some watching this video will correctly say that only having 10% of this portfolio in the F fund implies there are only $78,745 in reserves in the F fund that could be pulled from for income during a down stock market, which is less than 1 year's worth of cash flows and is conventionally a very lean allocation for somebody in retirement, and they would be right. So let's run the same scenario, but this time with an allocation to the F fund of 25%. We have additional opportunity cost with a slightly smaller expected ending portfolio and theoretical safe to withdrawal rate, but $75,000 of annual income, or $6,286 per month, is still almost 5 times more income in retirement than the theoretical $1,335 from the TSP strategy. And now, because we have increased the F fund from 10% to 25% weighting, there are $193,000 in reserves in the F fund to pull from during a down stock market, or 2.57 years worth of cash flows. Or we could go even more conservative to the financial industry's standard 60-40 model, where 40% is the target allocation to the F fund. There are even more opportunity costs than before, as shown by a reduction in the expected assets upon retirement and the lower expected rate of return of 8.86%, which implies an annual income of $67,593, or $5,633 per month, 4.2 times more than the TSP strategy. Now 40% of the portfolio would be in the F fund, which would allow for 4.5 years of reserves to pull from during a down stock market. So that is why I think that there is a greater than 70% opportunity cost in retirement income reduction when people use the TSP Lifecycle fund system and other 401k plan target date funds for that matter, and why I can't recommend them. Because the allocation mixes are rarely optimized and the funds start going too conservative way too soon, and why I recommend my clients use the C fund during growth years, and we'll discuss a proper retirement portfolio to shift to about 5 years out from retirement. that considers their own risk tolerances and income objectives, which may or may not require allocating some space to conservative investments like the F fund. If you appreciated the analysis in this video, make sure to hit the like button and leave a comment. And don't forget to subscribe and check out my other videos on topics like how to determine a reasonable rate of return, how to protect yourself from scams, and even how to solve the national debt problem. And if you're interested in learning more about WatchGuard Capital's professional investment management services, see the description section of this video on how to contact me, and we'll go from there. I'm Stephen Paluga with WatchGuard Capital. Invest your time wisely.